Our next speaker is Dustion Yoder, who's a CEO at Sureify. Dustion Yoder is an insurtech entrepreneur with a passion for next generation of insurance sales and policyholder engagement. Dustin was early to insurtech and has been primed to make a splash in the insurance space since his high school days working at the family brokerage. He's one of the few people who goes to sleep thinking about increasing persistency, our dreams of insurance innovation. In pursuit of his passion, Dustin formed Sureify in 2012 to revitalize the life insurance space. Prior to Sureify, he built and eventually sold Vanda's Products Lab, an enterprise product development company that served clients such as Genentech, Stanford University, and Honda. Now, Dustin wants nothing more than to use his entrepreneurship talent to meaningfully impact the industry his father thrived in. Dustin has received a Bachelor of Arts in Finance from California Polytech San Luis Obispo. He lives with his wife and daughter in San Jose, California. So off to you, Dustin.
Wonderful. Well, it is a pleasure to be here today. I know we have people from all over the world, I think. At least I'm sitting here in San Jose, California, the Bay Area. Not sure the state for everybody else in lockdown, but it's a pleasure to see all you, no matter where you sit, and hopefully one day we will see each other again in person, hopefully sooner than later. Thank you for that wonderful introduction. I did want to just do one thing and confirm time loss, so I make sure to stay within it. Can you get?
Yeah. So like in general, you have about like 90 minutes, right?
Okay.
So depending on how you want to do it, you can speak for like 75 minutes and then leave
Okay.
15 minutes on the rest, or just in general, just tell us how you think. But yeah,
Great.
I will give you a warning about the time if we get closer to the limit.
Wonderful. Yeah, and I say that because I want to make sure, like, I'd love for, while we go, everyone, as I go to get involved. I mean, I can sit here and be a talking head for 90, but the group isn't too large, right? With we got about 32 of us on here. I'd love to be able to answer questions or kind of in real time if possible. So feel free. You won't distract me because this is kind of, I'm living and breathing. If there's things that come up, I'd love to talk about it with each of you. And this will largely, I can go for the 90, but let's, if you want to ping it, please do that. And just know that that's completely fine with me. So hopefully that works today. So to start off, I think the question is, why am I here? And that nice introduction. It's always weird hearing a little bit about yourself, at least how the marketing person wrote it. But I just, the little background is I did start working in the insurtech space in 2012. So for the last 4 plus years, we've been a B2B software company. So we only sell into large insurance companies. We are largely North America focused, although I've spent time all around the world. We've done accelerators and different engagements in Japan, Singapore, Switzerland, Spain, wherever else. So like a whole wide range. So definitely, and had experience kind of globally. But yet North America and actually Japan are two of the largest life and annuity markets. So that's where I have most of my expertise. The other thing to harp on is people always ask how I got into this. The answer was, and that was quickly covered, but my father was in the insurance space for, and still is, but for 30 years of me growing up. So kind of, that's where I got my feet wet in comfort around insurance. Because I originally started the company when I was 26, however many years ago now, 10 years ago. So I am here. Just for a little context on what Sureify does, and why today I'll be focused on talking about life and annuity transformation. They're specifically life and annuity digital transformation and where it's going. We're talking about the future of life insurance, and why I think I have an angle on that is largely because I'm spending time, energy, and for the last 5 years investing in life and annuity digital transformation. And we get to see how everything comes together. So our platform is called Lifetime. And we have 3 modules: Lifetime Acquire, which enables the digital sales for agents, call centers, and direct to consumer; Lifetime Engage, which enables insurance companies to engage with their clients, or their in-force policyholders, as we call them, post-sale. So those that own accounts, they can engage. And then Lifetime Service enables the servicing of those policyholders. All of it streams down into a core platform, or like a data layer, configuration layer, etc. And then it sits on top of the policy administration systems. So a big part, I say, the relevance here is, like, we're sitting here in 2020, basically delivering the digital solutions. We're interacting with the 40-year-old systems that exist at many legacy insurers, but because of that, we're getting demand, and we're seeing how the world is pursuing data, is pursuing distribution, is pursuing different forms of technology, and really giving us, I'll call it, insight into how the world's developing. So that's kind of the core of why I have my views. So in the US in particular, the sales of life insurance today is typically more complex than over in Europe. And the reason is we can access back-end third-party data. My experience over in Europe is that there's data restriction laws, but ultimately, when someone applies for life insurance, we offer a reflexive digital sales tool, but also we orchestrate the third-party data calls from for medical history, criminal records, in some cases credit, but lots of different data calls to basically orchestrate and then deliver a what we call reflexive and accelerated underwriting process. I think my time in Europe has showed that this is not the case in most cases. At least from my experience, it's usually what we call simplified issue, where you're calling off of just a set of pre-written rules based on their responses. But in the US, they actually validate that data, like I said, with medical history, prescription drugs, criminal, to name a few. And so that's what our system does on the sales front. Ultimately, this enables the legacy insurers. We target about 450 insurers that we seek to sell to, offers them the ability to sell direct to consumer, et cetera. Then lifetime servicing. So what we've seen, our lifetime service platform enables these life insurers, which around the world, life and annuity products are sold through agents or banks. Obviously, in Europe, there's a lot of bank assurance taking place in the life space. But in Europe, in the US in particular, it's largely through captive and independent agents. I think those models persist around the globe as well. What we have done here in Lifetime Service is we're creating kind of the 2021 capabilities for a customer, an in-force policyholder, to be able to do all the things that you would call a call center for, fill out a form, or talk to an agent for digitally. So this is not to take away from the agent. It's actually it's more geared towards the customer of today expects to be able to do all these things digitally. And so when you look at the roles of agents, we both sales and service, we enable the agent to partake in this. But ultimately, like if I want to update my payment information, to call it simply, we all know that like we'd probably rather just do it on our mobile or web device than call a call center or an agent. And that's just, we see a large shift in the market towards the customer demand for this. insurers that are digital needing to have this, and then thirdly, like, this is just the way the world's going. So as the customer of the future is buying or continuing to be a service provider, they can serve them in that regard. And then the
So,
last,
Dustin, in the on sort of those two last questions about the integrating the medical history and the experience. So, it seems to me that there might be a little bit of the problem on the different level of digitalization on both the healthcare providers as well as the users. So, how do you sort of create the environment in which, let's say, there may be some records are not yet digitized, or maybe some people are not yet digitized at the same level. So, how do you sort of create this almost democratic solution where, let's say, less tech savvy people from both the medical side and the consumer side still feel comfortable with that solution? Do you have any goals, or you just kind of specifically tailor to the specific population?
so the answer is right now, and you hear me attempting to make sure that I know we have a global audience here. So I'm trying to like kind of express what I know about these markets. But the answer is one, you're totally right. When it comes to kind of the medical world as well as the insurers, they're in different digital journeys. So what's happening? I'll tell you from the insurer standpoint, we find most insurers are quite slow to evolve digitally. However, they currently have a manual process for this. So they have it's part of an underwriting process for the applicant to fill in that information and state who their medical providers are. And right now it's a manual process for that insurer, who basically submits, we call it a HIPAA request, but it's an authorization to pull that information, or the phone calls are made over to that. So it is manual. I cannot speak, for example, in Italy or other places in Europe, exactly if that's done and when it's done. My experience has been that it's a law that you take the customer's word for whatever they're saying about themselves. In the US, though, to your they need to validate that. And so when that happens, that's the current state of it. And so the insurer may be, very manual, but also the medical provider, right, may be manual. And then they basically ship that information back, maybe in the most archaic sense, they mail it back and forth. I think it's more likely today, at least they're emailing or, sending a digital copy of it. And then it's underwritten manually. The world that we're speaking of, kind of back here, is actually that transition is all taking place digitally. And so we are, to that point, we're implementing this system for our insurer. So in that case, a lot of that is, we're a big component of that digital, call it that digital tool, as well as the orchestration. Now, to your point, if the medical provider or that medical, we call it an EHR, electronic health record system, doesn't have the capability, well, that's, once again, that's going to break that link. In the US, though, there's a lot of laws that have been put in place that medical providers must offer the electronic health records to the policyholders through this request form. And so we're seeing a big, over the last 10 years specifically, we're definitely in a new place where most parties can access at least some of their medical records digitally. And so through APIs, the end of the story is, if we come in and use a third party API system to call that medical record, that's how it's taking place today. And I would say we're at a 30 or 40% maturity. So it's not a very mature process, but it is being utilized. And it surely is the way of the future, at least in the US, where everyone's being required to have the digital setup on both sides. Because what was happening is, there was some benefit from a stickiness perspective for the medical providers to hold that close. But now by law, the policyholder / the, all of us as consumers, we have the right to have that easily accessible, so we can switch providers. And that law has helped with that process. Does that add any clarity? I mean, there's still a lot
Yeah.
of challenges there, but that's the current state of
No,
the.
no, I mean it makes sense, and that's why we sort of highlighted that. Thank you.
And I do note, I do have my chat window open kind of front and center. So as people have anything, please type in, and I can go off a chat as well. The last component, so you see like everything I'm talking about that we do is on the sales and service side, which kind of leads into where the future is going, or that's where my insights come in. But on the engagement side, this is an area where insurers are really in a place right now where they've struggled to have more, plain and simple, to have a relationship with their customer besides when that bank or agent sells that insurance and when a bill comes. I think I'm stating the obvious across all of us in insurance and insurtech, that this is a major issue. What we saw, this was actually our first module in our product, but it's still a challenging one because the insurer is still trying to figure out what type of relationship makes sense. We now run some of the biggest engagement programs, which are not about sales and they're not about service, but rather how to digitally engage with a customer for years that they're with that carrier, through education, through polls and quizzes, through videos, through product updates, through health, through financial. So really saying like how do insurers transition from a transactional point in time, pure one life event, and then send them mail and bill them, to a world where they have a voice and a digital connection to that customer. I think the business goal there is to be seen as a bigger value add, but the opportunity with a value add is to have the ability to drive engagement with that customer, leading to upsell, cross sell, etc. So I want to take it. So that's I'm gonna transition here to a bit of the future, but I wanted to take a moment to ask, once again, I'll try to do this as we go. Does anybody have any questions or thoughts about kind of the current state of what we're doing, but also the industry, for example, in North America? Wanted to make sure, if anyone wants to throw anything out or type it in, I take a deep breath. And why we're here, if everyone doesn't mind, if you guys can type in the line of business that you're in or thinking about, I can speak, I can do some correlation too in the chat bar. Okay, so yeah, so I see someone type, thank you, P&C insurance, personal line. So I got a lot of insurance brokers. So this is good, thank you. Please type that in. That'll give me some more context as well. One thing I'll note there, as I see many insurance brokers, the interesting point that I'll bring up here is I'm working with the biggest insurance brokers, the biggest insurers in North America right now. And I want to highlight that everything you're seeing here is in a world where 95% of insurance 95% of insurance companies are distributing through insurance brokers. Well, so what's interesting is you've had this revolution, let's say, or this buzzy revolution and hype around digitalization. But I want to call out to everybody here that from my perspective, the two blending as well as they should hasn't happened. So you have insurance broker and the way products are actually sold. Like, I know all you on the phone know that this is the way it goes. But if you go over here, there's been this revolution towards digital. I think one of the biggest missing gaps here, and as someone on the front lines of digital, there is a missing gap, not only with the digital offerings being offered to brokers, but secondly, brokers adopting digital. And there's a two-part way here of like, when I go into insurers that are looking at massive, kind of system overhauls, what's interesting is sometimes they're afraid, I'm going to use the word, I'm using it afraid, I don't know what the right word is, but sometimes they're tentative to do big spend on digital platforms for their brokers based on usage, or they're afraid of adoption. So I don't know if that's common, across Europe, et cetera. But it's really interesting that like you see these big digital plays going on. I'm over on digital enablement. So you have these great new insure, in the US, for example, you have all these digital direct plays, but the agent is still doing all the business. I know you all probably know this, but not, even though the digital plays are there, they're only making a very small stab at the actual market share right now. And so I just think I'll call out that there two opportunities is just one for the insurer and for new digital capabilities to be driven to the agents and the brokers. But secondly, I think on the other side, it is a lot about agents and brokers transitioning their businesses to be more digitally focused. And this is a challenging thing, but I do see it's two parties, it's chicken and egg here of that taking place. But thank you all for writing in. I see, there's a decent kind of difference between a bunch of you on the call. But thanks for writing those in.
Dustin, maybe a quick question to prime things a little bit. So when we talk about this digitalization and connecting to sort of the customers of the insurance agents who sell on this, what do you think are some of the best practices of putting the agents on the same page with you, so they don't feel like you're trying to go over them and steal their business by offering those digital solutions?
Yeah, it's a great question, and that's what I was trying to kind of comment on there, was that, so I think it's a two-way street. So the insurance companies that the agents support, so if they're captive, right, they're just supporting one over here in the US, like the big State Farm, et cetera, right, which is one of our clients. They're just supporting their agents, their 20,000 agents. And then the flip side of that, right, is that there's the brokers. My father was a broker, just so you all know, and he was selling for everybody else. Now, here's the kicker: the insurance companies I believe, need to figure out how to empower their brokers with greater technology, because I think that's one angle. But also in the US in particular, the average insurance broker is 59 years old, which in the grand scheme of the workforce is actually is older, right? Because the average person hopefully retires, at least in the US, by 65. That's the desire. It doesn't always happen. But my point is like the average agent in the US is 59 years old. I don't know what it is across Europe, but what's happening there is you have the digital need of 2020 needing to be driven into these agents and these brokers, but yet it is more common, or it's a common belief or stereotype, that the 20-year, 30-year proven agents aren't as likely to change over to utilizing these tools. So it is a chicken and egg here. What the data is showing, though, is that the emerging agents are using things like text messages and push note, all the kind of things that we all use in our daily lives in their businesses, and thus it's showing that insurance companies have a big opportunity to attract the new form of agents with new kind of agent and broker focused tools. That just hasn't happened I'm going to call it on a mature level. I'm not saying it's not happening, but I'm seeing that we're still at this odds where the brokers and agents are feeling like there's this revolution to take them over. And then the insurance companies honestly don't care in many ways. I would say some of them care, like our agent focus, some of them are not, but they just need their business. They need to drive premium or drive new product sales. So it's a distribution issue. I think we're going to see over the next couple of years, those things merging is what I've seen and what I think. I'd be interested to ask the group here, specifically the insurance brokers on the call, my question to you is, how well are your insurance carriers supporting you in the digital process? Does anyone want to type in, a good, bad, et cetera? I don't know, or how well you feel they're supporting you. Does anyone have I'm looking at my chat or listening. I know we have some, I guess my question is, do you feel like you're digitally supported in your process, as you compare it, for example, with what you're seeing in the pure digital direct to consumer game? Well, so feel free to chime in if you have one. A 1, 2, or 3. Maybe a 3 is mature, a 1 is immature. I'll throw that out there if anyone wants to type anything in. But and also throw. So I see we have Francisco from WeFox, and then you have Lemonade. Comment on Lemonade. I mean, these are, in my opinion, these are examples of where, or what I've seen as a much stronger focus on the D2C direct to consumer game. But then the question is, are agents being given, and this is what I would say, and where I think the rubber, where these connect, are agents being given the same capabilities and the same tools that some of the direct to consumer games are playing? I think we're gonna see more and more of that, is what my hypothesis is, because in the life and annuity game in particular, I think we're going to see in 10 years, we're still going to have above 50% of all life and annuity products and financial products still sold by agents, even 10 years from now. Even if it's 95% today, my hypothesis is it's still north of 50%, which means agents, brokers, and traditional relationships are still going to be driving the majority of the business. So there's still this massive opportunity for the insurers of the future to drive, to basically enable it. This is where we come in. So like, as we look at our platform as an example, we're working to say, how do we take digital direct capabilities and all the things that the customer wants to do or the insurer wants to enable because the customer expects it, and how do we get that and shift it back towards the agent? So for us, it's not a, we call it the saying is baby in bathwater. We're not looking to throw the baby out with the bathwater here. We're looking to say, how do we best enable these parties so everybody wins? And even in the US, we're not seeing the agent business decline, but rather we're seeing it augmented by digital. So any comments, or I'll make a shift in kind of where I see the future going right now, but I wanted to ask any other comments. I'm going to answer Gerardo here really quick on Lemonade's, the comment here on Lemonade, but we'll go from there. So feel free to type in. So just a quick, as we look at WeFox, Lemonade, et cetera, as we look at Lemonade's recent entry into life savings. So if you don't know Lemonade, I'm sure most everyone here knows of Lemonade. Lemonade is one of the most hyped and went public recently as one of it was doing renters. It moved into home, and as of recently, and it's an insurance company, but it's pure digital, or largely digital from at least on the external side, meaning how you buy, etc. There's people behind it, but ultimately, recently Lemonade added life insurance. And my response to Gerardo here is that I think, one, they added life insurance through a partner ethos. So it's still a partner play in which they're just driving someone else's product through. But two, I think it's par for the course. So I think all these digital plays I'm sure there's a bunch, there is a bunch across Europe, but also in the US, what we're seeing every time, well, I'd say largely every time, is they're adding new business lines as they have better SEO or search, or they're paying for more eyeballs. They're wanting, as they have aspects of market share, or at least the eyes they want, they're adding new lines of business so that they can drive premium. I think there's probably it wouldn't be a secret belief. This is purely a belief. I definitely don't know Lemonade internally, but it seems like a very clear path that Lemonade will carry most lines of business over the next 5 to 10 years. And I think Lemonade also is working to be a global player, which is less common, for example, like a State Farm or an Allstate, who we see largely in the US here. Lemonade's both looking overseas as well. But I think they added life insurance, they have home. I'm not going to be surprised when they add other property and casualty lines. And one other thing to comment, I think a lot of these digital plays, if you see, they're also trying to empower, they're actually looking at empowering agents too. I don't think Lemonade is doing that now, but you can't quote me. But I wouldn't be surprised if another business line for them will be adding distribution through agents. It'll just be, a slightly different model. So taking a turn here, so why, as we get into kind of this macro view, I think I described like our business because I wanted everyone to understand like where my views are coming from. And the reason that is we're interacting with all the core systems in the life and annuity space. We're acting with all the current data, and then we're also interacting with the current distribution systems. Because of that, it gives us a view into the market that most people don't have, and we also have the insurers asking us for kind of future states or future capabilities. So I'd say like that's a benefit and an opportunity for us at Sureify to see kind of where the market's going. The other thing is I think it's pretty easy to say, well, since our daily lives have changed during COVID, and everything we everything we do in our life is expected to be on web and mobile, I think there's also some presumptions and hypotheses that are based off of Sureify's view of just where the world's going. And as you see here, I mean, COVID dumped fuel on that. I'd be I wanted to ask a question to the audience that you can type in, but what percentage of your business over the last year has been done using digital tools versus in person? I ask that because I'm interested to understand like the state of where you're based, of how much you're doing digitally versus sitting down with people. Do you mind typing in, what percentage, how much you're selling digitally? Oh, wow. I see here 95% of this business has been done. What's interesting is the next one says less than 5% has been done via digital. So big extremes there. But yeah, I think our challenge here in the US has been agents aren't allowed to meet with people due to COVID. And so that really changed the business models or what they had to do to be able to sell. And you can see here, like you have Lemonade here. I think the last thing putting a lot of pressure that's insightful into where life insurance is going is you have Lemonade on the P&C, right? You have Metro Mile with telematics, which I know, for example, in Europe and specifically Italy has been very strong on telematics for a long time. But you even have like connected toothbrushes, et cetera, where the world is very much into using both digital and IoT data to drive innovation across the space right now. And these are all life entrants in the US. So what you see here, as you talked about Lemonade and others, I know the US is substantially bigger than Italy and much of the the European countries, but collectively, obviously, you're seeing mass new entrants across the country boundaries. But this is just in the US where you'd say, how has the life insurance space been brought on with new capabilities? This is putting pressure on these traditional existing models. So I don't know if you've witnessed, but in the US, John Hancock, which is a Manulife company, they've released a health-focused product. So I'm not sure the state of Holistic Europe on life and health-focused products. But why I'm mentioning this is one of the most innovative sides of life insurance that's taken place, where John Hancock chose to bring in a rider in which if you live a healthier life, they will give you savings on your life insurance policy. So this was the beginning, I think, of that innovation of bringing in, kind of real-time data. You're seeing this at Principal Financial. where they're bringing in lifestyle and financial fitness into the enablement of their customers. And even State Farm, you're seeing where they're looking at the individual, and it's not, I think we're seeing a dramatic shift in the space from not just selling a product, but all these providers are trying to be a lot more. What's happening is insurers are realizing that the customer of yesterday isn't looking to just buy something, but rather the company that they buy from needs to be more of a solution provider than just that claim, even though the crux of, or the backbone of all insurance is that protection, or in life insurance, right? It's a death benefit. The life insurers have realized that if life insurance has the word life in it, the question is, aren't we supposed to be more than just a death benefit? And so that's really come into, whether it's John Hancock, Principal, State Farm, et cetera. I think that's a developing theme. So before I move on to kind of the future here, I see a question. What about the integration with Amazon Halo by John Hancock? Is it working? So we're seeing a lot of John Hancock. I guess John Hancock offered an integration with Amazon Halo. I think this is par for the course in that these insurers are looking to use whatever kind of the customer has to connect with them. And so they have from Apple Watch integrations to this Amazon Halo. Where this is all coming from is that they're looking to gather data from the customer, know them better, and then offer them benefits. I think if the insurer had it their way and the customer did, they would intake any of them, is the answer. But once again, insurers haven't been technology companies, or they haven't been IoT data companies. And so that's caused challenges on their speed in which they can implement kind of agnostic integration capabilities with all these providers. But yeah, I have no idea how that's going. I don't see behind the scenes. I work with quite a few insurers, but I don't work with John Hancock personally, so I don't know. So I think my hope is that as we look to the future here, it'll be relevant because my hypothesis around life insurance and the future of life insurance over the next 5 years should actually correlate strongly with the industry in general, because the themes aren't purely life insurance based. So if you look at my prediction areas, the first one here is distribution, which I think we spent a good amount of time talking about. This is nothing new, whether we're talking bank assurance, captive agent, independent broker, etc. Distribution's a big question over the next 5 and 10 years. What will that look like for us all? The second is risk, the backbone of all insurance products, right? And the underwriting of that risk. And then the third is product. And I think all of these, as I sit here as more of an industry, I focus as an industry on life insurance. I think all three of these are completely relevant for the greater space, because I know not everyone here at all is in life insurance. So the first thing is distribution. So what we're seeing today is that, as commented, like we have the agents doing the distributing, but there's really a small, and in North America in particular, there's a very small amount of core life insurers who have been around for 100 years that are doing digital distribution. And I don't think it's a secret at all that we're going to see more and more of either the companies you sell for, or if you work for a company, working to enable the simplest products first, going digital. The market in the US is 450 to 550 life and annuity companies. At Sureify, we focus on the 450 that we think are relevant. But as you can see, like my belief is that we're going to see half of them, or close to half of them, move to a world where they can both sell through their agents, but also they can sell through web and mobile. This shouldn't be a shocker. Behind every boardroom, I feel as though they're asking the question, not if we're going to do it, but one, how to do it, and simultaneously support our agents. What are the business models that are going to work? And two, it's how and when, right? So depending on how fixated they are on pure agent, I think the question is like, how do we do that, and when do we do it, as to not disrupt or simply put, piss off our agents? But I think there's a win-win capability. I think what gets more interesting is as you look even farther out, I see a very clear picture where the life insurers and the insurers of the world are looking for third-party distribution. And so this, I think, is going to affect us all here. The life insurer who sells through an agent is kind of an agent, and then that individual. What everyone's really reaching for is, where are those customers? And I think this is a question we all need to ask ourselves, is like, in every market we're in, what is the dominant purchasing sites, banks, housing, technology companies? My belief and what I'm seeing is that these parties have the eyes and maybe ears of the market much greater. You can have, like, we have 330 million people in the US, and we only have 400,000 life insurance agents. It's very hard to reach them. But yet, amongst Amazon, Chase, Zillow, and Apple, as an example, you could imagine that we have almost every eyeball in the US, or maybe multiple times over. And so there's a very clear path where these insurers, once they digitalize, will actually have the ability to drive third-party point of sale solutions. Does anybody have any questions on that? I don't know if that sounds foreign, like a foreign concept, but I just want to throw it out as an example, like when someone buys a stroller or something for their baby on Amazon, the use case there is, like, they now offer you a warranty, they could be offering you life insurance, or at least based on your purchasing behavior. Or Zillow, as they know you're buying a house. In the US specifically, people look at life products and some others to protect them. So it's those type of things. Apple knows all your health information, or is starting over, has a pursuit of it. So what will they be offering? So it's just putting that in your head. I know banks already offer, but as we don't go to the branches anymore, how will they push product? What's even making this more clear is that Ethos, Ladder, Bestow, Fabric, and we just talked about Lemonade. This is actually accelerating that, where you can see these companies are actually already pushing through, like Acorns. So Acorns is a new financial app that's done really well in the US. And so they're already pushing to these banking clients. When they, in your savings account, et cetera, they ask you, like, do you want to protect your life? And then they're actually pushing to these clients. So what you see is the digital startups and digital life insurance companies are already going to these third-party points of distribution. As Francisco says here, and the question is, well, do you think life insurance is a complicated product that needs physical interaction? So that has been a hypothesis or question for a long time. And the same kind of goes in the US. Life insurance is sold, not bought. But in actuality, depending on the product, Francisco, it can be quite simple. So I think, to your point, some of these products are very complicated and thus harder to sell digitally. And then some of them are quite simple. And so those ones are easier. And that's what we see the insurers doing. They start with the more simple versions of those products to sell first. So for example, a simple protection product which is common in the US, not an investment component. That's very easy to sell digitally, as an example. But an investment component can create more complications. I also would say insurers haven't taken the time. They really haven't taken enough time to digitalize their products and processes. So sometimes my response to this is, if an insurer created products to be purchased digitally, they would have a much easier time selling them digitally. But if we're creating products to be presented by financial advisors, brokers, and agents, there's a good chance that they're going to be made to be done that way, and thus very hard to sell digitally. So sometimes it's about intent, right? Like the way someone builds an e-commerce site and showcases an e-commerce product is quite different than someone that puts it on in the store at Walmart. And so I think that needs to be a deep consideration. You can see latter life, SoFi is a new financial provider. So embedded inside of this new bank and financial provider, a life insurer is going there.
Dustin, quick
All the,
question for you.
yeah.
When it goes to finance, right? And I spent about 10 years on the Wall Street working on the investment banking side of things, but there are sort of like the clear separation that you cannot sell, let's say, your investment products to your mortgage clients unless they have, explicit approval and they're explicitly looking for it. So do you think that right now it's all obviously in the startup case, but do you think that at the end of the day, there might be some kind of the limitation or some kind of the regulations that are imposed that, like, for example, you cannot use the data collected from your Apple Watch to offer you a life insurance that might be, giving you a higher or bigger premium given on the, how much you run every day or something like this. Do you think that there is do you see any developments in the industry that might actually lock this data and business and cross-selling information, especially in the life insurance space, where it's sort of, like the health and the very sensitive from the regulation standpoint topic?
So, there's always, in the US and across, like there's federal and or countrywide data laws, and then there's also like industry from a compliance standpoint, right? So you have these ruling parties. My answer to you is there's going to be restrictions, like there is restrictions, but the question is it authorized? One, so like I do not believe at all that insurance companies would do anything. They're going to be more conservative, so they're definitely not going to do anything that from a federal level is not allowed. And I think that's why everyone across Europe and in the US is getting very strict on data. But if you ask for that data, it's very different, right? Like when we all go to websites, right? Based on the ruling data laws in Europe and also the US, like you have to clearly state, right, that you're going to collect information. Or when someone works with you have to clearly authorize any interaction and or data collection. So the answer is it's more about transparency in that, and then you can move forward. That's on the federal side, right, of just pure data governance or data laws. The insurer side, you're going to be, I think, number one, in order to sell products, as you mentioned, I mean, you have to stay within the laws. Now, if people have the license, right, if you have the licenses to sell certain things, that's the only time it's going to be available. Those aren't changing, right? So all these, there is restrictions there, but I would say we're not seeing. I'm not familiar with the exact restrictions that you were under, but in regard to insurance products, for example, it's definitely very common for someone to have a license to sell the different financial products and insurance products. Like that isn't, I guess in the US in particular, that isn't restricted. Now, maybe differing products, like you would have restrictions based on what do you call it, interests, but this isn't, I guess this isn't coming up as much. I think everyone is worried about data though. So let me make it clear, no matter where I have been over the world the last 5 years, it's all about, data access, data clear, making sure everything's very clear. And I think the comment that I would throw back is I think a lot of insurance companies and their legal teams will start out concerned because that's their job. I think what the world, at least in the US, has been finding is on average, people are willing to share this data. Um, I use the word on average because there's been a lot of research done around this, and a lot of surveying and a lot of understanding. And secondly, as long as it's clear what you're doing, I think all these new data laws are about protecting the consumer. But if the consumer is giving you something knowing that, that's where it changes. So I think the question will always go back, what does the consumer want? And if they want that, then I think, then there shouldn't be an issue. I think if that changes and no consumer wants it, then I don't think the insurers will be able to access more data. But in the US, it's not really a question. Like, it's interesting, right? When we look at, like, when I look at life insurance or the way we underwrite in the US compared to Europe, I barely understand how they do it in Europe because they can't check, they can't validate anything. There's almost like data laws restricting that. In the US, if someone says they're healthy, but many people lie, right? Like, we have to validate that to give them the insurance because people have $5 million policies, right? So if they have cancer and they're going to die next month, the insurer needs to know that, or else they're going to be out of business. And so people have to be honest, and we use data verification. So people know what they're giving. I think the short story here is people know what they're giving to an insurer, and or they know what they're giving them access to. This isn't nothing secret here. But I don't know if that solves the issue, but that's what we're seeing in the market.
Thank you.
So when we look, the other thing is like, I don't know what your guys' state of, like, all the insurers that you work at or working for. I think, the big question is always what's going to need to happen for these to take place. I think, like, the upgrading of the current legacy systems is really holding a lot of insurers back. Most insurers don't have, like, real-time data access. I'm sure many of you have worked in the space, know that getting real-time data from your insurers can be a big challenge. And so APIs and SDKs are not as available as one would think. And really, like, the ability to build products that can be sold in real time is, like, takes a lot of the first two to get to. So, depending on what the state of this insurer will dramatically affect its capability. And so I'd also say the insurers that aren't investing in the teams to distribute and build out these type of relationships are behind. All right. So the next prediction here is about risk. And I think everyone on this call has probably seen this as well, on all the lines that they sell or involved in. I'm obviously speaking specifically to life insurance, but this can be drawn across. Right now, as I mentioned, we collect, medical information, electronic health records, criminal record, et cetera, driving record to assess someone's risk of their life. I know that's very different across different countries. But the prediction here from the North American side is, I believe that we're not only going to assess risk, and this is the big turn we're seeing, but we're going to also look at reducing risk. And so there's a dramatic, I think this is the change that's being demanded by the insurers, is that that insurers cannot just assess risk, but they need to care about that individual business or whatever that is buying these policies. And so they actually have to start looking at risk reduction capabilities to their policyholders. So, like, right now, we're in a world where we're doing, so in health insurance, right, we're looking at physical, financial, and mental. These are huge areas that affect, like, for example, mental health is one of the biggest killers, in the US. and especially certain population groups, physical health, right? Like heart health, diabetes, et cetera. This is a huge area. And so what we're seeing now is that, we're seeing that basic limp in, I'm calling it a limp, meaning it isn't mature yet, but the ability to start tracking and encouraging people to get healthy and driving them there. That's the step one. Now, due to the advance in technology, the next stage that is coming right now is that, there's a lot of IoT and data-driven capabilities that are tracking this type of stuff and helping people reduce this risk. So whether it's smoking cessation, so the ability to help people get off smoking, which is obviously a major risk factor to a life insurer, medication adherence. A lot of people, if you look at like these diabetes programs, et cetera, or anybody with a major ailment, medication adherence is one of the biggest risks, because if people take their medicine, they survive, and yet many people do not, and yet they, thus they're more likely to die. And so these programs, or diabetes management, all of these, if you look at the biggest killers in life insurance, and it even goes now, it's going into, I mean, I could correlate with all the other spaces in insurance. The question is, are we supposed to be just assessing that someone has a risk like smoking, or is it now the insurer's opportunity and maybe even responsibility to try to help people reduce their risk? And so some would say, no, an insurer should stay out of my business. Well, risk is the insurer's business. And so what happens if the insurers start offering reductions in payment, reductions in fees, and or positive opportunities to reduce this type of risk? I wanted to ask, I'm interested to know from all of you here, what your thoughts are, if you want to type in any comments here. Do you think that insurance companies are going to start leaning into risk reduction, not just risk assessment? Even if you say yes or no, I'd be interested to hear. One of the main reasons is the customer of today, it seems as though, is expecting organizations to show that they care. Now, for example, if I want to smoke, I don't want anyone telling me I can't. So they can underwrite that risk. But what happens if instead of your spouse trying to tell you to stop smoking, an insurance company will pay you because you're going to live longer or be healthier? This is where there's a big opportunity. And so this is why I say risk, not just risk assessment, but risk reduction is a huge area. Like, as an example, when we're digitalized, we have in our engagement suite, we see Net Promoter Score, which is an area people focus a lot on here in the US. We see Net Promoter Score as a big area people want to focus on. And we've seen some of our clients improve that by 20 points just by kind of offering baseline care to their customers. But yet we're still not really getting involved in offering, major benefits. And so we think, like in the health insurance space, where they're focusing on this risk reduction, now with they're focused on basically cost ratio comparison. And life insurance is all or nothing, right? And so when you look at life insurance, over the long, either someone dies or they don't, right? And so we see that it's a two-way street, where the customer feels like that life insurer says, we want you to live, and secondly, the insurer gets a benefit of also possibly reducing risk. So that's just a developing trend and thesis.
So Dustin, another interesting question that as you said about the engagement and mitigation, that's a lot of this drug and medicine adherence is on the big topic of a lot of pharmaceutical companies, right? Because to them, obviously, this is something that they're trying to track a lot of like, okay, are people actually following their drug? Is their drug effective? Because that could be even a possible liability. So are there any channels of sort of like the partnership with those providers, with doctors, with pharmaceutical companies on that, on sort of, if we track in the medicine adherence for once, maybe we can use it for the other and share the data? What are some of the possible partnerships there?
So I would say like the depth in which you went there on the pharmaceutical is deeper than is much deeper than where I see these partnerships arising. So my answer is I'm not experienced, or I'm not an expert down on that level. However, in my past company, I was building a medication adherence application. So I also I was doing that for a hospital and a cancer doctor, and so that gave me a lot of insight prior to doing the life insurance platform into seeing that correlation that you just described, partly because I didn't realize what a big deal it was, so much so that, like, it kind of leads into this slide here. Like, diabetes is a good example here, where if you take your diabetes medication, test yourself and do X, Y, and Z, diabetes can be managed very well, because that person is adhering to the plan to basically control your diabetes. To that point, the challenge, and I know people in my life, they don't take their medication. They do not follow the adherence. And so the doctors have a really hard time correlating. Now, life insurers are getting in that game to say, well, if you adhere, you're actually a good risk. If you don't adhere, you're a very bad risk. So where the partnerships I see is right actually where you're looking. So John Hancock has partnered with a diabetes management company. So just to be clear, not on the medication level, which I describe as lower than I'm aware of, but rather there is now technology and specific condition management companies that I see insurers partnering with. And so what happens here is you can create products based on conditions, and then you partner with a specific company that's specializing in managing that condition. So it's not so much, to be clear, that company will have vast knowledge on the medications, et cetera. But really, the insurers don't. I don't know if insurers will go that low, because they can't really control kind of the hot medicine or the medicine of the year. Let's say like the new and emerging. They really want to focus working with providers that specialize in that, and then they kind of outsource that that factor. Does that make sense?
Yeah, that's perfect. Thank you.
Yeah, and so that's what I see. I'm definitely seeing that as a more common trend, is my statement. I believe the first step is not insurance companies basically creating this in-house. I don't think that's necessary. Insurance companies typically waste a lot of money and time doing that. They should rather partner, and have multiple capabilities on partnerships there to make sure they're getting best in class, but also not getting weighted down with the cost. They can control cost a lot better there. So I always end like, what's needed here. I think what's interesting about insurers is they tend to refute like taking that next step. So when you look at a lot of the things I've suggested here, they haven't. And usually, like, they only do all or nothing, but they really need to create testing of these programs to validate or invalidate the goodness of them, because unless they have large amount, point here, if they don't have large amounts of data, then actuaries and thus then underwriters will have no interest in getting involved this early. And so what's interesting is that whenever you go into an insurer and you talk about projective capabilities, if they don't have vast amounts of data, they won't do it. Well, the irony is, if they don't start a program, they'll never have vast amounts of data. So it's a chicken and egg. The other major issue we see is that underwriters and actuaries are not involved early enough, and behind the core the core, a core product is ultimately going to be created and validated and underwritten by actuaries and underwriters. And so technology and innovation players are still limited on their ability to see something go broad and mainstream. And yet, if they can get these parties involved early, start collecting vast amounts of data, and then continually testing over a multiple year, kind of program, the likelihood of success in emerging as some type of leader here is dramatically reduced. I think each one of these things tends to be a big problem. Even if someone starts a testing of a program, if they're not willing to look at it on a multi-year level, it tends to be that not enough data is collected. So I can talk around in circles on what I see all the time, but this is kind of the factor. Moving into the last prediction here is around product, and actually the last piece that I was just describing is actually a lot of where these predictions lie. So long story short, what you end up getting is like today's products are pretty standard. Like in Europe, we see a lot of bank assurance and broker sold products that are, they have yearly renewables, et cetera. In the US, we have a lot of term products, 10, 20, 30 year. We have very specific whole or universal life policies. And it's pretty standard. I know, like, you ask the audience, has anybody heard of a new, I'll ask you all, has anybody heard of a new life product in the last year, right? Like something that was revolutionary different. Usually that answer, please type it in if you had, but usually that answer is not very common. So what that means though is there's a new area of focus that's coming in where the question is like, if we're looking at changing products, the question is why? And I think the answer is because our customers are changing and expecting different things, but it's also an ability to create new opportunities. So the first one is like time period, right? So looking at differing time periods of these products is really important. Like letting people, because we're in a very everyone wants everything fast here in the US specifically. I can't speak to every different culture and capability, but like reducing the time periods or just in time aspect of life products is a big one. The second one is conditions, which is what we were talking about, looking at specific risk conditions, controlling those, but creating specific products for those. It's almost like auto insurers, like some auto insurers focus on bad drivers and other ones focus on good ones. That would be another example of where in life insurance, we've largely focused on just like healthy people, or what we call as like the top tier. And then we either reject or highly price the others. I think what we're seeing is certain conditions are manageable, yet they're catastrophic as well when poorly managed. And so looking at being able to manage those conditions and create like the John Hancock product for diabetes. And then the third is personas. I think, we've spent years, I jumped ahead of my slides here, but ultimately time product, hold on, I'm going to show you here. But yeah, we spent years basically focused, at least in the US, so much of our life products are sold to older males, as what was like the more traditional view of a family. And I think the personas of today and tomorrow are changing, whether that's different types of parents and relationship, different health conditions, different points in time or life events, whether that's the new home buyer things, but creating products that are very catered to these new individuals, I think is emerging as an opportunity, and I say a way for the industry to expand and look at when to get involved. Keep in mind, life insurance is largely today obviously sold through agents. In the US, they're largely male, and as I said, 59 years old. So with digital though, what's interesting is that it's opening doors to really target new personas and use cases with those products, that I think was not cost effective in the past, but now is emerging as much more of an opportunity. Um, I'll end kind of the presentation with the last kind of forward looking, call it future that I see possible, and that's with the possibility of what we call dynamic and real time products. With the world of connected devices, data aggregation across many platforms, and also like a data exchange capability between life insurers and lots of providers, like I mentioned, health and medical, all the above. There's this new emerging opportunity, and this goes to one of what we talked about earlier about, will people allow this data to be exchanged and what they want. But ultimately there's an opportunity to create new real-time products. So here I like to use, hopefully you can tell I'm a pretty, I don't mind using myself as the example here. And so what you see here is you see me in 2009 with my wife, and now you see me last month with my new baby daughter, my other daughter, and then you see me last week right on the Peloton here. Well, what you may notice is that I've gotten less healthy. And I show that because the life insurer has hypothesized that. But the question is if we had real-time data on this, could we be creating, kind of a real-time view? And so I think maybe my earpods went out. Hold on one second. Can you guys still hear me?
Yes.
Okay.
Yes, all good.
Okay, thank you. My other one's going to go out here in a minute, but we'll be all right. So what's happening is there's a real-time view capability, and so as that goes, I think why I use this as use cases. When I got married, I was 23, a non-smoker, non-diabetic, etc., and I was in premium shape, and so I had a certain survival, or we call it survival or risk curve, that was the following. It looked good, and I had really cheap insurance. And my BMI, like I said, was healthy, normal, etc. But what happened was, 10 years later, is I actually gained, if you can believe this, from the time I got married, I gained about 50 pounds. And so I was about 226 pounds.
Oh, believe me, we can.
You can, okay, good. And so what happened is there started to be new relative like risk factors brought into my life. Like my blood pressure before was non, hypertension, etc. It was in a good place. My blood pressure after became mild hypertension. So by the way, these are all like kind of EHR pulled data, and you can see here my curve started to change. When you look at my blood glucose pulled from my blood exams, before, right, and then which was very healthy, and then after, it started to go up, and these started to be more pre-diabetic. So you go down this shift, and all of a sudden the world is offering me this real-time data, but potentially this could be ways, and this is a way that the future could emerge for the life insurance, for the policyholder. And what's interesting here is people tend to go to the negative and think insurance companies would raise their rates. Well, my statement to you is all of this is under the guise of this is the expected unhealthiness of someone. What happens if only by encouragement and positive reinforcement we drove people to a longer, happy, healthier life? And so I say that because none of it has to be negative or rate increases, because maybe you did expect that if I was healthy here and my life expectancy was going to go down, but maybe you expected this, and this happens to do with risk pooling, that you actually build this into your models. But if this is real time, you can actually encourage and hopefully change like reduce the variance from an ideal model, and you could actually see, those that are moving away from like that happy or that healthy place. And the goal of the insurer could be to drive them to a happier, healthier way, thus reducing risk. What that can do is you have expected liabilities, and long story short, if the person's less healthy, right, it moves to the right. And if they are more healthy, it moves to the left. But the expected right is the 250 in the middle of perceived, annual expected liability. Well, if you can take people to a happy, healthier place, you've possibly changed your business model and your book's value, and thus the person feels cared for, and you drove them to what is, their life, so to speak, but also had a financial benefit. So as we had talked about earlier, the customer has to want this. We need to seek agents to understand what customers want. And we need to bring in actuaries and underwriters early to see this future. We also know that this is going to be over time, but I believe, just like in auto, telematics, and other things, this is a very real future for either specialized products or proactive products that actually just benefit the customer for doing things better than expected. So I'll digress there. I know we have some time left, but hopefully that was a good overview of where I see the future going.
Perfect. Thank you so much. And it's really interesting for me, because we constantly work with a lot of companies that they do other things, and it's actually really interesting to see those mergers and how a lot of companies actually thinking in the same space. So please go ahead with the questions. Okay, so while people are being shy, so just again, to type it in, voice it over any way you want. But what do you think is the biggest slowdown of all of this development? What do you think companies are not realizing that maybe they should be realized to sort of start this journey and go forward on with that?
Yeah, so it's always a chicken and egg. Like, that's the problem in insurance, right? We base our risk off of the past.
Mhm.
And so we project forward, but the question is, what aren't we projecting? And so I think right now we're in a place where we have a lot of legacy systems. And if I may, we have a lot of legacy business models. So it's very challenging for someone to get started. I think one of the most underestimated things we're seeing across the space is how digital that customer would be or would want to be. So it's very common for insurers to tell us that they want to do web-based things first. But then when we release web and mobile, they see 70% of interaction done via mobile. So like, as an example, if someone, so you ask about progress, right? Well, if people have an impression that their customer would use web or focus on web, but yet in actuality, the numbers show that people use mobile, there's a misaligned belief in what the customer wants. So I think that holds things back. If you believe what the customer wants was what you were going to get, I think people would drive more digital. I also think there's a lot of false beliefs about, well, and I have to speak from a North American perspective, but even your comments on like sharing data and data privacy, we find that the number, like, people are willing to share a lot of things when understanding it won't be used against them. And so there's been negative, press on certain things, which has led insurers, compliance teams, and legal teams to believe that people won't share data. But the irony is, people share data like crazy, and actually, if that data is used to educate them and personalize their experience, it changes everything, and actually they get better scores. So I think and then lastly, it's just insurers specifically in the US have a lot of people that have worked there for a very long time. So it has a lot to do with the fresh perspective of if you come in with preconceived notions or beliefs from the last 20 or 30 years, it's very hard to shift that and spend real dollars. But as new leadership comes in or big demands on the business changing comes in, we see that shift a lot faster. So those are some big reasons why, I guess I'd say.
Yeah. So we have a question from Luca. In your opinion, why actuaries are not so involved in this whole process?
It's a great question, actually. I find it, so I'll tell you the good and the bad news. Sorry, I'll tell you my experience. They sometimes are involved, but legal, security, and sometimes actuaries like to say no. And so here's the catch. If there's a negative view of something before it ever gets going, it's very hard to get off the ground. So what happens is the digital teams and innovation teams I think they feel like they should say they don't invite them in early enough. And I think that's a mistake. But I also think that I recently presented to the Society of Actuaries and giving them feedback on actuaries. And that was one of my points. I think actuaries have to recognize that there's very little value in no. And like, as someone, I have our team's, coming up on 200 people. And I like to tell people, like, you're not in this position because you know how to point out the problem. You're in this position because I want you to help me find the solution. And I would say that's where the change needs to happen. It's not about no, but it's about how. And so actuaries, I think people in the old legacy land of legal and compliance, security, and even actuaries, there was some kind of like value in being the no person. And I think the world has changed where no is not a valuable answer. How is? That doesn't mean it's going to happen. I want to clarify, it's not about being a yes person, but no one gets much value out of no, because let's presume that everything's no until it's a yes. And so I would say that's probably why they're not involved, is there's a little bit of a negative like innovation view of actuaries and underwriters. I work with a lot of actuaries and underwriters, and that's like, I get to work with a lot of the progressive ones, but I think that's one of the negatives that falls on the industry because it's so data based. If you don't have data to prove the yes, it's just a no, but that's not what the world's looking for anymore. I think the world is all looking for how, and show me if I did X, then I could do Y. So that's my response.
Awesome. Thank you. Another question from Francesco. If I look at the Great American brand with their rating driving their take-up regarding the annuity market, how can new digital commerce overtake this competitive advantage? Will agents servicing their customer with such a strong brand buy into the new digital models based on the new customer needs, personal and new segments of the markets to satisfy?
I see a couple good questions here. Well, so I think like for instance, like annuities is a challenge in general with rates and stuff right now. So I'm just calling out a couple. Like I think that the the global market. I mean, I spent a lot of time in Europe over the last 4 years as well. So I'll start by saying it's hard depending on interest rates and whatnot. There's some non-digital or progressive factors affecting the financial world. So I can't. The truth is, as you all know, I can't speak to that. I'm more saying that's changing the attractiveness of certain products. And obviously ratings affect that. But at the end of the day, it seems as though in those type of financial based products, some people are getting killed there. The insurance companies are getting killed with old, guarantees. And now with the interest. So like, I almost have to plead the fifth, meaning I can't comment on that besides what we all know is the challenge. I'll go to the next one. I think there's this question, will agents servicing their customers via such, via the strong brands, buy into new digital models based on the new customer needs and new segment. So my answer is yes. I think, let me tell you why. So one, as described, the agent of today in the US in particular is specifically an older party. So they're not, the next 10 years may be ruled by them, but they're still there. I mean, if we're going to have agents at all, the US, if the average one is 60 years old, right? I mean, let's call it what it is. I mean, you're having new people come into the game. I think those parties are definitely going to change because their customer is different, right? If you tell me today, I had a friend that Charles Schwab is a big investment account here, and we investment, management company. And then we have all these new emerging fintech, management platform. I remember very clearly my one friend telling me he was switching everything out of Schwab because he couldn't believe that when he wanted to withdraw money, he had to wait like a week or something. And then he could press a button on these new investment accounts and transfer out 200 grand in 5 minutes. He maybe had a waiting period, but it was like, it was just this clear thing that the customer wanted it. And what was so interesting is he was so angry about that he, like, in my mind, he was willing to switch out of Schwab. And I'm thinking like, well, if you really look at it, if you let's just say they both have this, let's set the return as the same. It just seems like you wouldn't want to lose business or your customer of tomorrow that wants to take an action. You want them to feel empowered. It doesn't mean you're going to lose the business, but if you now try to restrict them through controls or non-digital experiences, I think over time you will lose that game. I think banks have seen that very clearly. I mean, there's been massive consolidation in the US and banking because of that. That's my comment there. I think the writing's on the wall there that, over the next 10 years, I think there has to be evolution. I'm not going to say it's going to die altogether, but I think the people that are going to win is what I call are going to lean into omni-channel.
Yeah, I want to add a little bit to it, right? Because we do work with a lot of those financial companies, and they come in and they say, how do we compete with Brex and SoFi and all of this? Because on the one side, that it is exactly the same product, it's just a better customer experience. As you said, it's still trading stocks, it's still doing the loans, but it's suddenly they actually eating into the revenue. And the problem is that there's so much capital in the Silicon Valley and beyond that they absolutely find financing non-profitable operations at the moment, just in the case to go and chase that revenue. So the venture capital will go and waste all this money and will not look at the profitability if you can win the customer. So the only way for those companies who are already in the business, the only way for you to actually defend yourself from it is to actually follow your customer. Your customer should be in the beginning of everything. Otherwise, that Silicon Valley money, they have more money than you. So that's
well, and you've seen this, like I can describe my experience with Sureify, starting in my garage till now. So I had to take out a credit card with my own backing, right? And then fast forward to today, we use Citi and Brex, and now we move from that credit card. Now we use Brex, all right, because of all the advantages, and they've come in with a business model that I don't want to use my original Chase business card. So I canceled that, gone to Brex. So they met me there. And then when you go to Citi has not been a good experience. We die every time we try to do something with Citi. It's it had its benefits, but now we're in the market where it's like, who's going to be the best digital bank? Once again, if it's Citi, great. But if it's, a different financial institution that makes our lives easier, my CFO and finance team mixed with me, like they don't meet that need. And I say that openly because it's like a nightmare to do anything on these old platforms. Well, keep in mind, it has nothing to do with the banking or the logo or anything. We're searching for the most the most progressive and easy to use systems, presuming that they're not going to steal our money. But in these, they're not. So it's like, there's that, but like these institutions have to change, or like people like us that want to move fast are going to go. It took me 5 years, by the way, to get off my Chase card onto a complete Brex world. But it does happen. And now we're at 5 years with Citi, and now we want to get the hell out of here because it's killing us, right? We're just so over the challenge every time. So there's so much to this. Once again, it doesn't mean we want to leave Citi, but we want to leave Citi because they don't work at the speed we work. And I think that's just the evolution. I just recently looked at a graph of fintech players taking over banking. And it was like 10 years ago, it showed market share and it was like 0. Like you couldn't even see fintech new banking. And now I think new banking establishments in North America is at like 10% market share over the, so it just keeps eating it up because they're slow to change, and, the new fast digital and enabled solutions are quick to change.
Yeah, absolutely. All right. Any other questions from our audience? Okay.
Well, thank you everyone for listening. I know not everyone was in life insurance here, but hopefully there was a lot of, I think it's all transitional to, hopefully you can compare it to the worlds that you focus on, because I see direct comparisons. I'm just not an expert outside of life and annuity. So thank you for the time. Thank you for listening, and feel free to reach out anytime. Dustin at Sureify, you can always send me a note, or you can continue the conversation.
Perfect. Thank you so much, Dustin. Thank you so much.
All right,
Greg, thanks so much too.
Bye-bye.
Thank you.